For more on today's market action and where we could be headed next, let's bring in Liz Ann Sonders of Charles Schwab. Liz Ann, welcome to Fast.
Nice to be here. Nice to see you guys.
Where are we in this rotation? Is this for real?
I think to some degree it's for real, assuming the expectations around the shift in Fed policy at the September meeting come to fruition. That said, I think the extreme outperformance that we've seen by smaller cap stocks by the Russell 2000 is not likely to persist at that same pace. I see it more as we're likely to get bouts of this type of action where you get some profit taking up the cap spectrum and there is money looking for opportunities down the cap spectrum. But I wouldn't expect it to persist to the degree it has in the past, week and a half.
Is it not wise at this point? I mean, a 10% run or so over the past week in small caps. I mean, we have to also think that the small cap index is not made up of the most vibrant companies. Some of them are fallen angels that just have declined in value so much they've gotten into the small cap index. How should we approach thinking about small caps at this point?
Well, don't approach it monolithically, because I think that's a real danger. Small caps is a big category. Even the Russell 2000 index has, even though it doesn't have 2,000 stocks, it's got 1,800 and change. And if you go to just pre the CPI report, which of course was the point at which small caps inflected relative to large caps, just as a for instance, within that index, if you simply broke the index into two categories or two cohorts, profitable Russell 2000 stocks and non-profitable stocks, there was an 18 percentage point spread between those, with the profitable stocks handily outperforming that index itself and the non-profitable stocks not only underperforming but in negative territory. So that dividing line, you could do the same things with zombies versus non-zombies, with high interest coverage versus low interest coverage. And I think on a looking forward basis, maybe in part because of this rally that we've seen, I think you want to lean into the quality side of what's working, but maybe fade the lower quality side of what's working within those smaller cap indexes.
Hey, Liz Ann, it's Tim. So that sounds to me like you continue to lean into equal weighted. And again, an index, if you look at that, that's done half of what the S&P has. But the fact is, we're in the middle of bank earnings. It's been a very strong re-rating period for banks. There's an argument they could continue to re-rate. Energy, healthcare, you're starting to see some laggards across the energy space. J&J had good numbers out today, and at least some of these stocks are moving. You think about asset allocation every day. Can people follow this?
Yes, but I think even within something like equal weight, it's not all created equal in terms of the stocks. I think this is an environment where you can't make monolithic decisions, whether it's at the index level, whether it's at the style box level, whether it's at the cap level, even at the sector level. I think factor-based analysis and screening continues to be appropriate, because both where leadership has resided and where it hasn't at the factor level has been much more consistent relative to leadership trends at the sector level or at the index level. So even within equal weight, I think you want to have that factor-oriented approach and stay up in quality. And that may seem like the ultimate duh statement. Why wouldn't investors always want to be in high-quality stocks? But of course, there are times where it makes sense to go down the quality spectrum. That's where leverage to an upturn in the economy is, or a major move on the part of the Fed to go from tightening to easing policy. I'm just not sure we're at that point in the cycle. So that's why I say I think you want to fade the lower quality, lean into the higher quality, and that's within small caps, even within the context of equal weight.
Liz Ann, it's Karen. Thanks so much for being on today.
Karen.
Question. I love it's not a monolith. I sort of live by that. So when you talk about the Russell, I understand you don't want to make this sort of capital allocation to the monolith, but when you think about the quality there, are there particular industries that you favor now over others?
I wouldn't say it's at the industry level. I'd say, again, it's at the factor level. So even though we're looking at a Fed that possibly is going to start easing policy in September, they're probably not inclined to do it aggressively. So to some degree, even in an easing cycle, we're in a higher for longer backdrop. And that is still, I think, suggestive of focusing on factors like high interest coverage. I already mentioned the profitability spread within small caps, the non-zombie type companies, strong return on equity, ample free cash flow, those profitability metrics. I think that's the way to approach the market in this environment. And that can be applied across sectors, across industries. Within leadership sectors, there are great stocks and there are crappy stocks. And I think in this environment of lower correlations and wider dispersion, having gotten the return of the risk-free rate, ostensibly connecting fundamentals to stock prices again, leveling the playing field to some degree between active and passive, I think this is an environment where you want to be more factor-focused than sector or industry-focused.